Welcome to the podcast series Talking Success, connecting the global FinTech community. I'm Stacey Jafta, and today I'll be chatting with Zachariah George, Managing Partner of Launch Africa. Launch Africa is a leading Pan-African VC fund, solving the significant funding gap in the seed and pre-Series A investment landscape in Africa. Zach, how are you doing?
Very good, Stacey. It's good to be here, and thanks for having me on your show.
I'm so excited. This has been a long time coming. Yeah. There's a lot we want to discuss. Eager to pick your brain about a few topics. But how's your last week? How's the last month been for you?
Yeah, it's been good. It's obviously winter in the global south in South Africa where I'm based. Yes. But I had the privilege of spending most of June in Europe, meeting our investors in our fund. About 60% of our investors are from Europe, primarily Switzerland, Germany, France, the Netherlands, and a few other countries. So we decided that we'd spend most of summer, when the sun's out in the north and people are in a good mood to meet partners.
Great tactic.
Versus having to deal with the cold of South Africa in June, and it was a very good trip. Because we had 2 years of COVID where we couldn't meet any of our investors in person, and you feel like you build these incredible relationships with LPs. I mean, LPs are short for limited partners. You meet them on Zoom, you exchange emails with them, but getting to sit and have a meal with them across a table and share a glass of wine is just it adds a human element to it. And these are people that have entrusted us with hundreds of thousands, if not millions of dollars of their hard-earned capital, and making the trip out just to go meet them without any agenda around further funds or capital is just a good thing to do.
So this was one of your first trips post-COVID. Have you seen a change in the way investors look at Africa and specifically fintechs in Africa?
Yeah, I'd say the understanding of Africa as an investment destination has gone through quite a bit of metamorphosis over the last 5 years. I mean, as little as 10 years ago, no one would ever associate innovation and venture and entrepreneurship with the African continent. The African continent was pretty much in the same sentence as international aid or donations or grants or just sort of, maybe in certain cases, foundations would look at it as an extension of venture philanthropy.
Yes.
And, venture in Africa only really started taking off, I would say, the second half of the 2010s, so 2015 onwards. When I came to South Africa in 2010, 2011 had only about $5 to $10 million of venture capital on the entire continent, and that number has now gone up to over 5 billion in 2020.
Yeah.
So it's gone up by, 1,000x in, just under 10 years. So the understanding of venture capital and the opportunity to invest in tech and tech-enabled entrepreneurs in Africa really started taking off about 5 years ago with the revolution in FinTech. And I'm glad that this podcast has a particular interest in FinTech. And it's not because other tech companies, tech ventures, sectors aren't relevant. It's just that it's to build an ecosystem from the ground up in something like healthcare, education, infrastructure, mobility, logistics, supply chain cannot happen unless you have a solution around payments, right? Because Africa is 54 different countries, and not just countries, multiple tribes, regions, cultures, demographics, purchasing patterns, etc. It's very hard to look at innovation in other sectors unless financial inclusion is sorted first. If people can't pay for something,
without a doubt,
people can't borrow, if they can't lend, if they can't save, if they can't invest, then how does anything else make sense, right? So So that was one of the industries that had to be disrupted first before others could. So if you look at the first major fintechs in Africa going back 7 to 8 years, so Paga and Flutterwave in Nigeria, M-Pesa, if you want to call it a fintech in Kenya, in South Africa, the first major fintechs, if you look at Yoko, look at Zona, and then fintech derivatives. The revolution, for lack of a better word, happened about 5 or 6 years ago. And it's now gotten to a point where fintech powers other industries. So if you look at retail, you look at insurance, you look at banking, you look at supply chain, they all have fintech elements of it. And the sort of venture capital ecosystem really started to grow once large corporates in South Africa, large corporates in Kenya, Nigeria, and to a certain extent Egypt started to work with startups. I've been in South Africa now for 12 years, more than 12 years, and corporates largely ignored technology startups because they viewed them as pretty much irrelevant. And not really affecting their bottom line whatsoever. And then what happened about 5 years ago was the end consumers started to wield a lot of control and influence in the way corporates delivered products and services. So this sort of shift in mindset was driven by consumers, not by producers. And that coincided with the start of the gig economy. People wanted to own less assets. So people didn't drive enough cars. They didn't make enough food. They didn't study enough courses. They were like, if someone else is doing it, let's just do it. Let's share assets. So we went from an asset-heavy economy as little as 7 to 8 years ago to an asset-light economy. I'm talking in broad brushstrokes here, but that's what kicked it off in Africa. So.
Zach, before we go any deeper, can you just give a brief overview on your career journey and then essentially what led you to become managing partner of Launch Africa, just to set the scene?
Yeah, it's quite an interesting, uncharacteristic, unconventional career. So I started off as an engineer. I grew up in the Middle East in Oman. I went to university in the south of India to a university called the IIT. It's called the Indian Institute of Technology. It's one of the most technical universities in the world. It's where a lot of the modern tech CEOs from Google, Microsoft, etc. come from. After 4 years in India, I went to Stanford, got my master's at Stanford and specialized in corporate finance and management. Obviously, fantastic school. And spent the next 8 years working on Wall Street as an investment banker. So I was at Lehman Brothers until they collapsed, and then I was at Barclays for a couple of years. And then I found myself in South Africa in 2010 for the World Cup, the soccer World Cup.
Great experience.
Yeah, and I had no specific agenda, but I just was completely consumed.
Did you come on holiday?
I was here on holiday. Yep, I was here on holiday.
Wow. Okay.
And I just realized that there was a massive opportunity in the. Venture capital was not even a word back then in Africa. So it was a huge opportunity in the SME world from a financing, growth, and scale perspective. And I just figured, I was 28 at the time. And I just figured there was so much more to do. I started working very young, by the way. So 28 seems like young, but I've been working for almost, 9 years before that. And I decided that I would, jump into the deep end and be part of a small group of people, mostly expats at the time, that would launch the venture capital industry on the continent back in 2010, 2011. But we didn't launch a fund. What I ended up doing is setting up venture building studios. The first incubator and the first accelerator on the continent of Africa, funny enough, was set up by us in 2015.
Oh, wow.
With Barclays. It was called Tech Lab Africa, which later became Techstars.
Yes.
Yeah, Barclays Rise. Yeah, and then on the heels of that, I co-founded Startup Bootcamp in Africa, which is one of the largest accelerators for early stage technology startups globally. Um, Startup Bootcamps. Startup Bootcamp is widely recognized or compared to Y Combinator, but in Europe. Y Combinator tends to have a very American focus. Startup Bootcamp was YC's equivalent in Europe, and then we helped bring Startup Bootcamp to Africa. So I co-founded that together with a guy called Philip Kirikoff. So we ran Startup Bootcamp for from 2016, late 2016 till 2019. Startup Bootcamp still runs a very tight ship and a great cohort, but remember, accelerators are a key part to the journey of a venture, but they're not the be all and end all. So you've got venture building studios, which are sort of ideation labs. You've got incubators that take ideas to prototype, and an accelerators take companies that are typically post prototype and get them to a point where they start to generate revenue and they have a monetizable business model. What accelerators then do is they, during these 3 months or 6 months, whatever the sort of modus, whatever the MO is, you typically have between 6 and a 10% stake in a company in exchange for a small amount of money. It ranges from as little as $20,000 to as much as $100,000 or more. And you have a lot of non-financial support. So you're helping these ventures with tech, with IP, with marketing, with accounting, with business plans, with their business models, etc. So it's very intense. It's a combination of workshops, seminars, case studies, client interviews, and meeting investors, etc. So it's a very intense 3-month program. Exchange for equity, and some of the top accelerators in the world are Startup Bootcamp, Y Combinator, Techstars, Founders Factory, Plug and Play. So
Yes.
So we ran that for 3 years. Startup Bootcamp had a very unique business model where the program was funded by large corporates that helped with the distribution process for a lot of the top tech founders. So we had 10 companies in a cohort. We ran a cohort a year, and they would help our portfolio companies with access to market, which is often the biggest challenge that founders have outside of just capital. So, I co-ran that for 3 years until the end of 2019. And then I figured that, the missing part of this relay race is still, venture builders, incubators, accelerators. What happens after that? So what happened is you'd go through an accelerator and then you would start building, slowly increasing your revenue. And once you got as close as possible to $100,000 in monthly revenue, often called MRR, monthly recurring revenue, you'd typically be ready for Series A, right? So we noticed that ventures would take anywhere from 2 years to 4 years, or sometimes even more, up to 5 years post accelerator to do a Series A round. And that is unacceptable. That's just way too long in product development, way too long in customer validation. Whereas startups in the US and in China and India and some parts of Western Europe were doing this in a year or 2 years. So that was sort of the brainchild behind Launch Africa. I mean, I'd co-run the largest accelerator in Africa, and I said I've got a lot of access to really good founders from Egypt down to South Africa and every major geography in between. If we were to start a fund with smart capital from individuals, family offices, angels, and smart corporates that could back the top graduates of these accelerators in their journey to getting to Series A, we could pretty much own the market, and that's what we did. We were looking to start the fund with a very modest target of $10 to $15 million in capital. And as they say, the rest is history.
How did you know that the investment world was for you? Like, what intrigued you?
So, I've never been cut out to work in corporate. That's something I realized very early on. I think one of the when you go to a university like Stanford, where everyone in your class or that you come across in the hallways or in the cafeteria or just on campus is out there building something very unique, be it, a startup in the healthcare space, the education space, the financial services space. Stanford's a place where creativity is born and gets excelled at, right? So it's not like, I'm not here on a mission to tell people how amazing Stanford is, but as an alum, I can say this. There are certain business schools like Harvard, Wharton, MIT, Yale, etc., that groom people to be great CEOs of corporates. But Stanford's not the university you go to do that. You come to Stanford because you are, inspired by people like, Sergey and Larry from Google, or, the guys behind Yahoo or NVIDIA or, Amazon. It's a place where people go where nothing is impossible, right? So you say, if you can dream it, if you can build it, there are people that will, that you can surround yourself with to change the world. So I always knew that I wanted to be an entrepreneur, right? But being an entrepreneur requires you to have a lot of capital to start your business. So the reason, of course. So the reason I did not directly become an entrepreneur after Stanford was because I decided that I would have to. Well, I had a couple of $100,000 in student loans that I had to pay off. So I went to Wall Street to basically help pay off those loans and build enough of a track record from a corporate finance perspective. And the thing about working at investment banks is it helps you develop a very analytical, logical decision-making framework in order to make responsible decisions. And that's something that a lot of entrepreneurs that haven't had, years in consulting and banking or private equity have. So it introduces a certain amount of fiscal discipline that is a great complement to your creative, productive mindset that founders typically have, right? So after spending a few years in Wall Street, I just realized that I wanted to be an entrepreneur, and I couldn't, and I would never, excel working under authority and working for a paycheck, which is nothing wrong with that, but just wasn't for me. But being an entrepreneur and doing just one thing just also didn't sit well with me, because I'm probably undiagnosed ADHD where I just have to do a lot of things. And the only career in my mind at the time that would allow me to use my financial and sort of business logical analytical mindset married with the creativity of a founder was an accelerator or a venture fund, where you work with multiple founders solving multiple problems, multiple regions, multiple products, and you're a mentor, an advisor, an enabler, and eventually an investor in multiple entities. And you get to benefit from the upside when any of these ventures or all of these ventures take off, and you can see massive socioeconomic benefit to the beneficiaries of these ventures. So that's sort of why I decided to get into the investing industry.
And then what do you think makes someone good at investing? Is it a gut feeling, faith in the founders, or do you have more of an analytical approach? You mentioned going to Stanford and just Wall Street in general helped you just have more of an analytical mind, understanding that approach. But what do you think in general makes somebody good?
It all depends on what stage you're investing in. So if you're investing very early into companies that are either pre-revenue or just barely post-revenue, it's to a large extent, it's more of a gut than it's more science. It's more art than science. I mean, no doubt about it. Right? So no matter what someone's business plan says they're going to be achieving in 5 years or 10 years, I mean, it's all thumbsuck. It's just not worth the paper it's written on. So very smart early stage investors do a lot of diligence on the market, trends, margins, growth rates, user adoption, customer conversion rates. There's so much more. Well, there's so much that goes into studying a business sector before you even talk to the entrepreneur. So let's assume someone is, building a, corporate expense management solution. I'll give you a real example of one of the companies we backed, right? Before our team even looks at the pitch deck of this company, we've done enough market research on, the target market. What is the size of small businesses in, let's say East Africa, for example? What is the average spend that employees have per month in a given ecosystem? What is the conversion rates of corporate card spend? How easy is it to penetrate different markets within that ecosystem? There's a lot of research that you have to do, and a lot of this research is available publicly, or you have to do it through industry partners or institutions.
Yeah.
Right? And then you have a conversation with the founder, and ultimately, the first couple of meetings, it's like dating. It's been said before, and I don't want to keep making comparisons, but you want to just say, does this person or are these persons founders, throwing you a fake? Or are they talking sense? So once you establish that these people are legit and that they know what they're doing and they understand the industry, then you start talking about their product. Way too many investors, get sucked into a product sales, and it's like someone telling you how amazing a car is when you're buying a used car. Like, I don't care how, what's in the car. I want to know, where am I driving? What am I doing? It's a bad analogy, but, there's no point listening to a pitch deck or pitch from an entrepreneur if you haven't done your market research as to what the customer uptake and industry trends are. So as a VC doing early stage investments, you've got to do a lot more homework than one expects. And then once you're on the same page and you understand that the entrepreneur is legit, they understand the industry, they have some experience, then you start diving into the product, what it actually does. You start looking at competitors. The thing that people forget is VCs see hundreds, if not thousands, of pitch decks every year, if not a lot more. They often have a better understanding of a market than the founders, right? Just not because they're smarter, just because they see more information, right? So, being a shrewd investor requires a lot of prep work, significant amount of prep work. And number two, you've got to be able to build a trust-centric relationship with founders. If you don't have an element of trust where you are a mentor and a coach to a founder, not a captain. You never want to captain a founder. You want to coach a founder. And you want to be able to add significant amount of non-financial value to a founder or a founding team. That's how founders pick good investors and vice versa.
There's also no guarantee when funding a business, and it's even more risky in the pre-seed phase, as you mentioned. How do you hire for your internal VC teams? Like, how do you challenge or test whether someone will be good at this? You mentioned, obviously, the research, being able to understand trends, but is there anything else in the interview stage you look out for?
You mean like hiring for a fund?
For your VC teams, yeah.
It's not easy. There's the skills that we look for in our team. Let's be honest. We have been doing quite a bit of interviewing lately in the last few months. Working at a venture fund has been glamorized a lot in the last few years, right? It's been viewed as something very sexy or very interesting. It's very cool to work at a VC fund, but the reality is it's a lot of work. It is an exceptional amount of work because you're dealing with multiple companies. In our case, we've got more than 100 portfolio companies that we've backed over the last 2 years. You have to really, to be a good venture analyst, you have to know a little bit about dozens of industries, right? It's like almost getting a mini MBA whilst you're doing work. So, I'm not saying it's impossible, but your reason to work in VC is not because you want to get paid a lot of money. Because I'm sorry to burst the bubble of all the listeners on this podcast, but you don't make a lot of money if you work at a VC fund in the short term, right? I make less money now at the age of 40 running a VC fund than I did at the age of 26 or 27 working at an investment bank. Okay. that itself would be, come as a shock.
So you're saying don't do it for the money, but do it for the interest in investing and the kind of businesses you get exposed to? Or you're saying that it's more risky where you take the risk and it's a bigger payoff than going into investment banking?
Yeah, it's a mix of the two, but it's long-term versus short-term incentives. In venture, you are making calculated decisions on companies where you're getting in early, and you have an equity stake in these companies until they mature, grow, exits, sell, or where you can do secondary exits to later stage companies. So your payouts in anywhere from 5 to 10 years could be huge. Could by several degrees or factors, surpass what you could ever work at a bank or make at a bank or a consulting firm. But it's skewed towards long-term incentives versus short-term rewards. So if you're doing it for a nice fat bonus every year in December, don't work at a VC, right? So it's incentives.
And I'm sure that there's obviously not an exact formula that if you do this and this and this will end up being success, because I think then everyone would go into it, use that formula. But have you seen any trend with your portfolio businesses that do better than others?
Scott, could you design a video game?
I could make you a hypothetical one. If I took some random genres, mechanics, maybe blended them together, and created a new hypothetical game.
Now that would make a great podcast.
Undoubtedly.
So what would you make? Something original and exciting? A Dark Souls city builder? A co-op roguelike?
Everything. All of that. We could use the Nemesis system from and put it in a first-person shooter. And we could have a loot system with survival mechanics and motion controls. And maybe you could, save a kingdom from some out-of-control toasters. What about party?
Catch the Gaming Blender on all your favourite podcast platforms.
Oh, that's such a general question. I mean, honestly, if you're pretty much asking which portfolio companies succeed, which ones don't. I mean, how long is a piece of string, right? I mean, yeah, it's just, I would say founders that really understand their markets, understand the competitive advantage, understand user acquisition trade-offs, understand. I think a key attribute to running a good venture-funded business is the ability to. I mean, I'm re-quoting Steve Jobs' famous commencement speech, which I happen to be at. Stay humble, stay foolish, right? So just be aware of what's happening in industry, be flexible, and be move like water, be able to adapt to changing industry trends. Don't get stuck on a particular product or a piece of technology just because you invented it or your co-founder invented it. Be flexible, be ambitious, but don't be arrogant. A lot of founders have egos the size of Russia, and they just cannot adapt, and then they die because ultimately, something, I think, what is the statistics? Something like 90% of startups fail within the first 3 years of going. And a large part of it is because these founders fall in love with their product and they don't fall in love with their market and their customers. So the customer wants something else.
I love that advice.
Yeah. If a customer loves something, it's such an old saying, but when you're building a house and someone wants to put up a picture and they want to hang it up on the wall, they're not going to ask you for a 12-inch drill bit. They're going to ask you, I want a 12-inch hole. If you use a drill to fix it, or you do it manually, or you use a pencil, it doesn't matter.
Yeah.
I want the problem solved. So the problem with a lot of founders is they push product, they don't push solutions.
They're very tech-minded.
Yeah, tech is one part of it, but if you're not solving a problem for someone, if your focus is solving a customer's problem, then the actual product should constantly change. You can't have a static solution for a problem that constantly evolves, right? So that's why I say to founders, your R&D team is not a once-off until you build a product. Your R&D is a constant part. I mean, the two most underfunded elements within a startup tend to be marketing and R&D, and those are the two things that probably need more money than anything else. So
couldn't agree more.
Yeah, so if once you're building something and you're selling product A into the market, your R&D team should be working on product B even before you've reached critical mass for product A. But large corporates do it. I mean, corporates like Apple and IBM and Adobe spend tons of money on marketing, but they also have a huge budget for R&D, right? So obviously scale that down proportionately for a startup, but you need to always be thinking of what's happening in the market. You need to be thinking a year ahead, 2 years ahead. And those founders typically do well. And, founders that listen to their investors, listen to their advisors, and are not afraid of being told what to do, but doing ultimately what's in the best interest of the stakeholders. Remember, as a founder, you've got multiple stakeholders. You've got your employees, you've got your investors/shareholders, you've got your customers, your clients, and then you've got your suppliers, if you're in that sort of vertical. And it's impossible to please everyone, but you have to really understand, how can you, do what's in the best interest of your company, and believe that. I mean, it's this whole like connecting the dots thing. Like you need to be able to connect the dots going forward. It's very hard to do.
Yeah.
But you have to trust in your gut and take the advice of people that are there to help you.
Zach, before we wrap up, I wanted to finish the conversation we were having before we pressed record. We're seeing a lot of companies, mainly in the US and Europe, pausing on business plans due to the market predictions, whether that's pushing out a launch of a new product or entity or pausing on growth plans. Have you seen the same in Africa?
No, I mean, so if you look at the stats, Africa is one of the only markets that is pretty much I wouldn't say counter-cyclical, but in this economic turmoil we've had in the last quarter, I mean, the last 3 to 4 months, we've had a massive downscaling in venture funding in Europe, North America, Asia, and Latin America. Africa is the only region in the world where you haven't seen that throttle, that bottleneck. It's been the opposite.
Why is that?
It's because ultimately, if you think about it, the amount of capital sitting in the world hasn't changed. It's just moved to different avenues. So if someone's sitting with hundreds of millions of dollars in assets, it needs to find a home. Just because the stock market's on giving you returns doesn't mean you're going to now put that money under your mattress, right?
Yeah.
The proverbial mattress, right? So you're going to find
Yes.
So you're going to find a home for it in regions of the world where you can get a better return. And, in many cases that will be emerging markets. And within emerging markets, you want to put it into projects, ventures that can deliver a social, economic, and, environmentally favorable return. And Africa tends to tick a lot of those boxes. Now, is everyone doing that? No, not necessarily. But sophisticated investors globally are looking at Africa as an opportunity. We're a continent of 1.4 billion people with the world's youngest population. I mean, the average age of the African individual is 19. The average age of a European individual is 46. Right. So just, I'll leave our, listeners and viewers to figure out, like, work the math out. Who are you building products for? Are you building products for a 46-year-old that, or are you building products for a 19-year-old that is arguably more digitally and tech savvy and has a much bigger chance of increasing their share of a consumer's pie? So, smart investors are seeing that. And we have a temporary lull in the markets, but, Winston Churchill famously said, never let a good crisis go to waste. And I think smart investors are seeing that. So
awesome. Thank you so much, Zach, for being on the podcast. Thank you for sharing all your thoughts. It was great having you on.
Absolutely, yeah, and I'm happy for folks to reach me by email or LinkedIn, and if they want to get more details, we are in the process of setting up Launch Africa Fund 2 later this year. So, not just entrepreneurs, if young people out there want to get more interested in investing in future technology innovators on the African continent, our fund is one of the best ways to diversify your exposure to founders. I mean, we've invested in founders from Egypt to South Africa and 20 different countries on the continent, and it's a good way to get exposure to an asset class that until about 5 years ago was pretty much privy of the rich and famous. So I'm happy for people to reach out if they're interested in getting more involved.
Fantastic. Thanks again.
Thank you. Cheers. Have a good one.
Thank you for listening to this week's episode of Talking Success, Connecting the Global FinTech Community. Feel free to follow us on LinkedIn at Talent in the Cloud. And if you're interested in exec talent, expanding your team, or you yourself are looking for a new, exciting change in your career, check out our website, talentinthecloud.io.